Hi, and welcome back to Consider This Program. I'm your host, Jamie Burton.
And I'm Rheaume.
We're so happy to have you guys here today. Today we're going to be talking about gifting while you're still living. What kind of gifting can you do? What's the most tax-efficient strategy for you? And why would you consider gifting today while you're still living rather than waiting until you pass on and then you pass on those assets? So Aaron, what are some good strategies that people can use today to give to the charities that really means a lot to them?
Yeah, there's a number of ways that folks can gift. We'll probably talk about two or three of them in the show today. I'll explain just what they are in a definition, and then we can elaborate on them. So we can gift either through what's called an appreciated asset. So maybe you've bought a stock and it's gone up in value and you haven't sold it yet, so we can do a donation that way. There's things called qualified charitable donations, or a QCD, where you can use part of your required minimum distribution to gift, and then you can gift out of income. So there's multiple ways to do it, and we'll try to break it down through the show.
Absolutely. So when we're looking at gifting of appreciated assets, typically we're looking at this when you aren't to the age where you're taking required minimum distributions yet, but you still have it on your heart that you want to gift. So this is typically the best way that we can find to where you're not gifting out of cash. You can still take advantage of some tax breaks and be able to give to that charity and be able to enjoy seeing what that money is doing for that charity. So can you talk about gifting appreciated assets for us?
Yeah, absolutely. Going back to the brief explanation is when you're looking at an appreciated asset and gifting overall, you're trying to figure out what to do that's going to help the organization because that's what's drawn to your heart, or a 501c3. Where you're really trying to go with that is how can you be the most tax efficient in that gift? And so sometimes when you're using that appreciated asset, we've had people sell that asset, and you have to take caution there because you want to make sure that the asset is transferred directly to the charity. So how this plays out is, again, let's say you have a stock that you bought for $10 a share, and over time it's grown to $100 a share. So there's a $90 difference in that share price. If you were to sell it, like some people have, you would recognize what's called a capital gain. And so that would be added to your tax return. What donating an appreciated asset does is allow you to avoid having that capital gain on that asset and still make a beneficial donation to the charity. So what you do is you take that same stock, make sure the charity has a donation account that can accept stocks, transfer the asset to the charity sells that stock, you get a tax benefit from that, and the charity doesn't pay tax.
Yeah, it's a great way to donate to these different organizations because you're getting a benefit yourself, and then your organization is getting the same benefit as if you were to gift them cash. So it's a really great strategy to use. So,
yeah, and the other thing to add there too from a tax standpoint, Jamie, is when we're doing that, we want to look at where someone's at in their tax bracket. Mm-hmm. And so we also talked about giving out of cash. Mm-hmm. So if you write a check to a charity, depending on where your income bracket's at, it may not be as beneficial because if some people are in those higher brackets, mm-hmm. You could be losing cents on the dollar every time you do that donation versus giving an appreciated asset.
Absolutely. And we've also seen that with the tax code change in 2017, they doubled the standard deduction. So typically a lot of people were able to itemize before. So they were able to take off medical deductions and salt taxes and different interest, and then those gifting, they were able to take that off on their taxes, and it was a big benefit for them. But with the tax code that we've seen in 2017, it doubled that standard deduction. So a lot of people, it no longer makes sense to itemize anymore. They just simply take that standard deduction. So while it's still nice to be able to give to a charity, they are no longer getting a tax benefit mm-hmm. from it. So this is a good way to be able to give to a charity, still be able to get a benefit out of it because you're avoiding those capital gains taxes, and then still being able to file the standard deduction and be able to get tax breaks in different ways.
Very good point.
Yes. So going on, you're gifting from your appreciated assets to your charity, but then you hit age 72.
Okay.
72 is the magical age where now you have to start taking out required minimum distributions.
Mm-hmm.
And a lot of times we see families come in and they're like, but I don't need this money. I don't need this money to live off of. And I sure as heck don't want to pay taxes on it. What can I do with that required minimum distribution?
Yeah, in the same way that you can donate an appreciated asset, you can also give a portion of your required minimum distribution. As Jamie mentioned, the RMD age starts at 72, but you can do QCDs at age 70 and a half. So qualified charitable donation, we do recommend that if you're thinking about those things to reach out to a fiduciary professional to help you with some of that tax guidance. But again, you can still give that a portion up to $100,000 a year at the time of this recording to a charity. And so we do have families that don't need their required minimum distribution money. And to help them avoid tax, you can gift a portion of that. The key thing there is, Jamie, when you were mentioning the standard deduction and the itemizations, with a qualified charitable donation, you do not get a tax deduction. You just don't pay income tax on part of or all of your QCD or required minimum distribution if that's what you're giving away.
Mm-hmm.
So
when you take the required minimum distribution, the way that it hits your tax return is it's counted as income.
Mm-hmm.
So you have to pay taxes based on whatever tax bracket you're in when you are required to take that minimum distribution. When you give away your required minimum distribution in the form of a QCD, that income does not hit your tax return. So that's the huge benefit of doing the QCD.
Yes, absolutely.
Yep. And then one other way that we talk about for somebody with a higher net worth that really wants to take advantage of the tax code and be able to itemize in a certain year to take advantage of, say, selling a business, or if they decided that it makes sense for them to do a big Roth conversion in a year and they need to have a higher itemized deduction, there's something called a donor advised fund.
Mm-hmm.
Can you tell us a little bit about that?
Yeah, so a donor advised fund allows you, and I try to explain this in the most simplistic way, is to kind of fast forward your donations. So as you mentioned, if you have someone that has maybe a high income in a given year because they sold a business or just something that was not a common occurrence theme from an income standpoint, what a donor advised fund is allows you to make a large contribution to that and offset generally 50 to 60% of your tax based on your adjusted gross income. That changes year over year, so we're in 2022. I have not looked at that at the time of the recording, so if we are helping someone through that, we would know those numbers.
Mm-hmm.
But yes, it allows you to make a large donation, offset a lot of your adjusted gross income, and potentially open you up to some other tax avenues that could be beneficial.
Yeah, absolutely. And a great thing is when you do a donor advised fund, you make that large contribution, but it doesn't all go to your organization in that 1 year. You can set it up to where it goes out to the organization over a number of years. So a lot of times when we talk to people, they are uncomfortable giving one big large donation because, for example, a church, you are used to giving a church a weekly check, let alone starting to scale back and giving them a yearly check.
Mm-hmm.
And this way, if you're doing a donor advised fund and say you're giving a donation that's going to be for the next 5 years, that can be a little uncomfortable. So with a donor advised fund, you can have that paid out over the next 5 years. So it's not just a lump sum that's going to go to your charity at that time.
Good point. The other thing, too, with a donor advised fund is it allows you to have investment options. So it's not just a large transaction of cash just sitting there until you decide to donate to the charity. It has purpose. It can grow. It can be invested. And, ultimately, you hope that you continue to grow those funds so that you can give more.
Right. So as you can see, there's a lot of different ways that you can gift to your church or to your charity that's whatever's on your heart while you're still living, and you can still see that benefit while you're still living rather than waiting until after you've passed away to give those funds on. One thing that we see when people retire is that they are gifting to their church or their charities based off of the income that they have coming in. Once they retire, that's very drastically different than from when they were working. What's your recommendation there, Aaron?
Yeah, that's another great point. And you're exactly right. From what we see is when you're in a working career, the standard rule of thumb is to give 10% or whatever portion that you can give. And so if you are accustomed to making $150,000, 10% of that's $15,000. Well, now you retire and go on a fixed income, and maybe your retirement income's 50, so 10% of that's $5,000. But you have this big bucket of assets that were saved up, and so it's just a matter of helping people walk through different life scenarios and what makes sense from the tax purpose. So we do see a reduction in giving because most people do it on income, not assets.
Absolutely. And if that's a conversation that you want to dive deeper into, please go to yourlifeafterwork.com or call us at 800-928-4001. Call and talk to Brittany and request a next steps meeting. We can help walk you through this conversation, and we can also walk through the rest of our 5 critical elements that we want to make sure that you're planning for, so your planning doesn't lead you to frustration and devastation if there is a hole in it somewhere. Stay tuned, and we'll be right back.